Hi, my name is Jordan Bennett. I'm the owner of Jordan Bennett and Associates Real Estate here at Keller Williams Realty. Our team and I have helped over 400 families buy and sell real estate here in Orange County. I'm excited to be sitting here today with Stephen Thomas, who I'm going to introduce momentarily. We would like to thank you for being with us here online tonight. Hopefully this will be an informative session here. Thomas here with First American. He began his career as a California real estate broker, and with decades of real estate experience and a degree in quantitative economics and decision sciences from UC San Diego, he has developed the reports on housing. He is often seen as a resource to the Orange County Register and other news outlets. I will let him take the wheel and introduce himself here in more depth and kind of find out what we're going to be learning about today. I'm going to leave the shot here and let Stephen take it away, so I'm not caught on camera making various different expressions and just sitting here awkwardly. So Stephen, take it away.
Right. Thank you. Appreciate it. Thanks for having me. And so it actually reads right? Because I did a Facebook Live where it was backwards. That's what kind of a rookie I was. It was my first one. My wife was yelling at me going, "What's going on?" Anyways, so I started reportsonhousing.com back in 2004. So I've been tracing the market ever since, and that's because we saw a change in the marketplace back in 2004, and I wanted to report upon that. So without further ado, let's get into this. But before we do that, I like to start off with some photo fun. I'm going to call this the spring photo fun. And these are just a conglomeration of photos that real estate agents take, and then because they go out in the World Wide Web and they're on the internet, there are people that devote their lives to scraping these off and then developed websites to poke fun at what the pictures that we take as an industry. And the reason why I bring this up is because Jordan Bennett, of course, he hires a professional photographer, so this kind of stuff does not happen. But you'll get a kick out of this like I always do and everybody that I present to. This is an indoor pool. And then we have photoshopped a photoshopped fire pit with photoshopped furniture in the back. And this is actually what we refer to as a multiple listing service violation, but still people like to take pictures of people a lot, and we see it quite often. As you see, there's Grandma. She's trying to stay out of the shot. And if you look hard enough, you see that this real estate agent brought his son, or her son, and if you could see the shoes by the curtain. And we have, this is just creepy. I don't know exactly what this is, but somebody is taking care of their cat for a real estate picture. And there are dogs. And there are kids that don't clean up after themselves, but let's still take a picture of it and put it up on the internet. Makes you want to go run by this house right away, right? Or this.
That's good.
Yes. And this creepy collection of dolls hanging from the wall.
It's like old Cabbage Patch Kids.
Yes, exactly. They have a little bit of a mold problem. Totally disclosed in this photo. That's inside. Yes, I'm not sure what... This is staging gone bad. Don't worry. Jordan only hires real professionals, but I'm not exactly certain why there's a chair with the...
Food bowl.
Yeah, and a dog food bowl. I thought this was ingenious, a little urinal. And then this is what we refer to as a selfie. I circled it so you could see it. There is still someone in the shower curtain and taking a picture of the bathroom. And you don't use a fisheye lens. And that's just a creepy picture of a basement with a creepy high chair. I would have nightmares if I was a kid and saw this. Because this is where you take the kids and make them have their time out. And this was actually a listing in Australia. It made a lot of newspapers on that. It was a fixer-upper. And it was, I believe it was on the Gold Coast, so it still sold for a pretty penny. But yeah, I'm going to say major fixer-upper. And this is Photoshop gone bad because you don't have clouds where the bushes should be. And, and this is somebody that actually took the Google shot, erased a few of the little things there, and said $206K. That's how much this particular property is selling for. So anyways, as Jordan was saying, I actually have been sending my stuff to Orange County Register since 2004. And back then, blogging was big. So they had a blog, and all the other papers and news outlets used to steal from each other. And they'd look to see what they were reporting on, and I'd be getting pinged by reporters all across the country, actually. So I made it all the way to the New York Times. I knew that I had made it to the big leagues when I made it across the coast just talking about Orange County real estate. So and that's all from just handing it out to the Orange County Register, and I send my report out to all these news outlets every other week as well. My background is I'm a quantitative economics and decision sciences major, 26 years in the business. I went to UC San Diego in La Jolla. Orange County native, Capitol Valley High School grad. I have 8 kids. That's actually a lie, you'll see in a second. And I'm an avid runner. Yes, these are my kids. Now, we are a blended family, in case all of you guys stop breathing. My wife brought those 2 on the left. And on the right, those are my 6. We blended them together. We had them all the time. I adopted her 2 on the left, and she's adopting my 2 on the lower right. And that adoption is actually happening. The celebration is next week from Friday. But everybody called us the Brady Bunch. I'm showing you how this is not like the Brady Bunch. It's a lot bigger. And I'm all for things looking uniform. So we have an empty little square there. And why do we have an empty square? Well, we filled it in. We had a little baby 9 weeks ago today, and his name is Ezekiel Creed. We call him Zeke. And he's, like I said, 9 weeks. He's a total blessing. And he just ties everything all together. So 9 kids. Here's my spring update. There's a lot of noise out there. I'm sure everybody's hearing it. And there is too much noise. And that's what I'm going to focus on today is a bit of too much noise, and then kind of peel off all the layers of that and talk about what's really happening in the real estate market. So here's what people are saying. Housing is a bubble. I'm sure we've heard that. I've heard this. Downturns occur every 10 years. We've also heard this. Housing will plunge more than the Great Recession. Interest rates are rising. The end of the run is near. How about housing is due for a correction? And I've been hearing this one. It's been just off the rails. The luxury market is slowing. I've heard that over and over again. And I'm going to slowly but surely tell you why you should be ignoring the noise. It's time for facts. Facts is data and stats. You can't really refute them. Where all this other stuff comes from are storylines that reporters, typically they contact me for different storylines, and I'll tell them the opposite, and they'll go find someone else that can talk about what they need to talk about in order to put it in their papers. So housing's actually on a really solid foundation. And the reason it's on a solid foundation is because this is not like the downturn of yesteryear. There's a lot of people with big down payments. There's a lot of cash in the system, and there's big down payments. So we're not as exposed as we were when we were doing subprime mortgages and negative AM mortgages back before the Great Recession. There is a lot of skin in the game this time. And no, there are not 10-year cycles. I can expand this thing way back, but everybody's talking about a 10-year cycle, and I have no idea why. Because when you actually look at this, 1991 was a real estate recession. The next real estate recession was not 2001. That was a recession, but it didn't hit real estate. The next recession wasn't until we got to 2007, 2008. That was a real estate recession. So really, we started in 1991, and the next real estate recession was in 2008. So if you're talking about cycles, we've got a long way to wait. So, but economics do not run in exact cycles. So all these people are talking about these cycles, and it should happen just like this. You got to look at the numbers, you got to look at the data, you got to look at the trends, and see where things are going. And here's a trend that you should be following. There's been a rise in incomes while rates have been going lower and lower and lower. And so you've seen we've had a rise in incomes that have been consistent since 1998. I've heard some people say that incomes are actually flat from 10 years ago, but that's not exactly true. And then also interest rates. If you look and see where interest rates are, we're right around 4.5% where we currently right now. And at 4.5%, you have to understand that is still a phenomenal rate compared to where we've been. We've had rates as high as 18%. We'll get into that in a minute, but you can see interest rates are low, incomes are going up, so it still means that there's still affordability in the market. And let's also talk about Economics 101, and that is supply and demand. Everybody understands supply and demand, but let's talk about it a little bit. We've had very little supply, which is the left-hand side, and we've had very high demand for quite some time, since 2012. And when that occurs, prices go up. Now, when you have a lot of supply and very little demand, prices go down. We're not seeing that, and there's no trend that shows that the end of this low inventory is going to happen soon. So once again, this is that tilt, demand and supply. When we have really low demand and high supply, that's tilting the wrong direction. But it's a seller's market when we have a lot of demand and very little supply. So, but I do want, here's something else that everyone's talking about, interest rates. Interest rates, when they go up more than 1%, which has happened a few times since 1990, if you see this, every time that it's gone up more than 1%, and once again we're going through that again, every single time we've actually had an increase in prices. And more recently, the increases have been really great. So during that same time period from 2012 to 2013, the interest rates went up 1.11%, and we had an increase in prices of 11%. So even though we have interest rates that are on the rise, we're still getting, we're still having a lot of people jump into the market, and there's still a lot of demand, so prices are on the rise right now. So let's talk about Orange County housing supply. And here are buyers. It is extremely frustrating being a buyer. Absolutely frustrating. And these are the real estate agents working on behalf of those buyers. Why? Because they have to show them countless houses. We write offers for them, and then they're one of 10 offers, so they have a 10% chance of getting it. They don't get the first one. Then they write up an offer, next one, they even write it above asking, they don't get it. This can happen over and over and over again. So you have to start the process over and over again as a buyer and a real estate agent. So you have to pack your patience. The lower you are in price, the harder it is going to be. And we'll show you that too. But let's talk about the active listing inventory and where it's at right now. This is the active listing inventory over time. We got all the way up to 18,000 homes in 2007, and this is where we are right now today. And if you draw a line right across this, we just breached 5,000 homes this week. And the long-term average is 8,000 homes. And that's 8,000. As you can see, we have, in 2014, we hit 8,000 homes and then came down from that 8,000 mark really quick. We have to be above 8,000 for a sustainable amount of time before the market will turn in favor of the buyers. So that's why we've been a seller's market ever since 2012. And 2012 started over here, and it's been a seller's market ever since. And this is where we are today. Although I haven't updated the slide, but I did crunch the number before I came here because I wanted to know what was going on in the housing market, because I actually crunch the numbers every 2 weeks, every other Thursday. The crunching is happening today. So I was excited to see what's going on in the inventory and demand, so I actually crunched the numbers for this presentation right before we got here. And this is where we were actually 2 weeks ago. We start off the year with 3,397 homes. We're at 4,708 homes 2 weeks ago, and that's up 51%. Now today there are 5,128. We went up 420 homes, which is 9% increase. We haven't seen this kind of an increase since 2007. So is that a blip? It might just very well be, because the 2 weeks prior was when Easter happened. And when right around the week before Easter and the week after Easter, we typically get a pullback in real estate. So a lot of people aren't going to be placing their homes on the market right around that time. And but we'll have to see. Or can it be a trend? Possibly. I still, right now at this point, think it's a blip, because we were on track to meet the pink line, which was last year, and that pink line again. So I think we might be just trailing right along where we were in the pink line, which means we barely hit 6,000 homes last year. Last year at this time, we had 5,268 homes. That's up 3%. It's a 3% difference from where we are today, where I crunched it just a little while ago. And sitting on the market, I have a lot of agents that talk to me about this. They have a home that's been on the market for over 60 days that is listed at $600,000. And below $750,000 is an extremely hot market. Yet there are still homes that sit. And that's there's a phenomenon that's out there that I call it the flip or the flip or flop, the TV, the different programs that are on all those cable television stations. There are a lot of people that are watching these things, and what they're seeing are these houses that are being renovated, and that's what everybody wants. They want that. And some of these houses that are out there are a little bit dated, and when they're a little bit dated, they sit a little bit longer. So if you're going to update it, you're actually going to do what a lot of people are taking advantage of right now. We have a lot of flippers in the market. They actually go out, buy the properties that are more dated, put all the latest bells and whistles in it at minimal cost as possible, and then make a profit. My whole point in telling you this is so that you can do all that with the capital that you have, or find capital. You do that as a homeowner, and then you place it on the market at that premium. It sells really fast, and then you walk away with extra cash in your pocket. If you do those things, you will actually make more than what you invest in your home in that short period of time, which you can speak to Jordan about, but it really does make a difference. That's why homes are sitting, because you've got these houses that are stinkers that are out there. And when you have a stinker, that's a house, and it's not being offensive. We all have lived in houses where we've been in there for a long time. We know the deferred maintenance and everything else that we need to do, and we just don't want to go all out and make all the necessary changes. We want to do the minor fixes. If you do all the major changes and do all the renovation to make it current to where we are today, you'll actually make more money on your home the way things are right now, and that's all because of cable television network. It's really changed the way that our psyche works. So, but as you can see, the higher the price, the more homes that have been on the market for 60 days or more. And this market, this particular graph right now is totally skewed. When I do this thing later on, like in a couple months, it'll be a third of the market or more will be below $750,000 will actually be on the market for 60 days plus. And when you start to get to 750 and $1 million, that should be more at about 35%, and it keeps on driving up from there. But right now, we just had a slew of homes come on the last 2 weeks, and I just did this yesterday. So this is updated for this, but there's still homes that have been sitting on the market for more than 60 days. And then I want you to understand this. There are fewer homes coming on the market. There were. I had to redo this a couple days ago, and I think it's actually going to be less and less. Remember, it's less than 3%. Now it's this. When I did it a few days ago, it's 4% less homes came on the market compared to last year. But look at this: the 0 to 500,000. There are 19% fewer homes in the market this year compared to last year. There are about 34% fewer homes compared to 2 years ago below 500,000. What is going on? And in the below 750,000, there's actually 11% fewer. And if you look, above 750, we're getting more homes coming on the market. 1 to 2 million, we're getting way more, 13% more homes. And above 2 million, 14% more homes coming on the market. So you have to understand that it's really the lower ranges. When I'm talking 750, unfortunately, I'm talking lower ranges in Orange County. For the rest of the country, that's double the median sales price. That's actually more than double. But for here, if you've got a $600,000 home, that's an affordable range here in Orange County. But the lower end is vanishing. It is poof. It's disappearing. And if you look at it, it's starting to affect sales. It didn't before. Before, we were actually fewer and fewer homes coming on the market below 500,000, but now there are so few homes below 500,000 that it's starting to affect the number of closed sales. If you look at this, the number of closed sales through April 15th is actually down 28%. That's huge. And it's down 6%, 5 to 750. There are just fewer homes coming on in that price range, and so many homes are starting to pop above $750,000. So we'll have to see where this goes if the detached home, the 5 to 750 detached home, is disappearing. The 0 to $500,000 townhome is starting to disappear too. So everything is starting at 500,000 for condos and detached above 750. I think that's the phenomenon that we're starting to see over here. And it's been a slow progression where it's getting there, but it's starting to affect the number of closed sales. Now let's talk about demand. there's still a big long line. If you place a home that's turnkey, ready to go, and has all the bells and whistles at $600,000, you're flying off the market in an instant. You're going to have multiple offers if you really sit down with Jordan and put the right price down for a home and really listen to true fair market value. It'll fly. It will absolutely fly. And but let's talk about demand. Demand, I take a look at the last 30 days worth of pending sales. And so if you look at it, we're off a little bit from last year. And this is where we are right now. 2 weeks ago, we were at 2,602. That is actually where we were. I have not had a chance to update this slide. That's 2,602. Today, we're at 2,624. And I just did that. So that's not really a big change in demand, although we're getting a whole bunch of homes that have come on the market. So it's a phenomenon that, due to the fact that they're brand new in the market, I'm wondering if they just haven't had a chance to get into escrow yet. We'll have to wait and see what's going on there. But last year, there was 2,981 homes that sold within the last 30-day period. So you can see, and that's that purple line. We're off from last year. And a lot of that has to do with not enough product below $750,000 coming on the market. If you've got a home below $750,000 that you're thinking about selling, understand that you'll be able to move fast and you'll be in the driver's seat on being able to call the shots. And now let's talk about expected market time. This is placing your home on the market. When is it going to go into escrow? And this is where we are today, the expected market time. I can't expect you to read that, but I want you to understand that a less than a 60-day market is what we refer to as a hot seller's market. This is a 90-day market is a seller's market. That green line is a seller's market. A hot seller's market is where we're driving appreciations up. We're actually at 59-day expected market time, so we're right now bouncing right below that really hot seller's market. So we're at a hot seller's market, but due to the fact that we had so many listings come on and demand didn't increase that much, that's why we actually moved from 55-day expected market time to 59-day. But this is at 90 days. And you can see we really haven't been above 90 days for too long. The last time we were there was actually in 2014, and we did that for the second half of the year. And that wasn't a buyer's market. It was what we refer to as a balanced market between 90 and 120 days. That is 120 days. And as you can see, above the blue line is a buyer's market. We haven't been in a buyer's market since we hit it barely in 2011 for a little bit. But it was more of, a buyer's market. A balanced market is in between. You can see it was a total buyer's market back in 2007, and is actually a buyer's market in 2006. We just had homes that sat. We weren't peeling off prices as far as appreciation was concerned because it was already the beginning of this cycle in 2006. And that's when you see when there's a cycle. You see that there's a cycle when the expected market time is ramping up and sellers aren't yet ready to reduce their price enough to sell. What I mean by that is reducing it below the last comp. There's no way that we're even close to that, because first we have to go above that buyer's market line, and we have to be there for a sustainable amount of time before the rest of the population goes, okay, I really need to move, and the only way to move is for me to reduce my price. We're not even close to anything like that happening. And that right there is what we call a deep buyer's market at 150 days or more. That's where we're really sliding in it and depreciating, and we just barely hit it for a small second in 2010, but you see it's really 2009, 2008, 2007. Orange County today is at a 59-day expected market time, and for all of Southern California today, it's actually at a 59-day expected market time. So it's a hot seller's market. And this is where we are. Oops, nice yellow arrow that I didn't move. Yellow arrow needs to move that way. There it is, that green line. It's hard to see because it's sitting right on top of the 2015 line. We're above last year's expected market time, and that's because we don't have enough escrows. We have less inventory, but we don't have enough escrows. So but we're still looking at an expected market time of less than 60 days. And keep in mind, a buyer's market is that red line, that 120-day mark. We haven't been there in years, and we're nowhere close to that right now. So those people expecting a turn, not going to happen. And this is the juiciest time to sell your home right now. And it ends in mid-May. And it's still a really juicy time to sell your home because May to June is still spring market. But once we start getting into summer, there's some distractions that come in, and actually our inventory tends to continue to rise during that time period. And why? Because we're a hot seller's market all the way up through mid-May. and then it'll start to pop above the hot seller's market and just be a seller's market. Still good, but just not as good as right now, today. If you've got a home that's listed at $650,000, that's in turnkey condition, ready to go, boom, you're dealing with multiple offers right away, instantaneously. But the longer you wait in the year, the longer that wait is going to be before you get offers. Although safe to say that below 750 is going to be pretty hot all the way through because there's such a lack of inventory, all the way through June, July, and it could be that way through the rest of the year. That's why you need to meet with Jordan. He'll be able to tell you exactly where it's at because he subscribes to this report. Mission Viejo is at a 30-day expected market time. Aliso Viejo is at 25 days. Ladera Ranch is at 46 days. And Rancho Mission Viejo is at 130 days. And Rancho Santa Margarita is at 18 days. Rancho Santa Margarita is actually the hottest city in all of Orange County. They have stuff that comes on the market and flies immediately. Coto de Casa is at 132 days. And I'm just doing that because that's generally where we're at. There are other areas that are slower, like Newport Coast, Laguna Beach, Newport Beach, that type of the coastal belt, and it all has to do with what? Price. Yeah. So what's going on with interest rates? Well, it used to be the safest place to park your money was bonds, but I don't know if you saw, bond market today was doing all kinds of goofy things first thing this morning. So when it's doing goofy things, interest rates are doing goofy things, it's hard to follow even what interest rates are doing on a day-to-day basis. It used to be interest rates were staying the same constantly over time, and it was the most boring thing to talk about. And us economists were talking about they're going to go up eventually. They're going to go up eventually. Well, guess what? They're going up eventually. They're going up now. It's because people are pulling their money out of bonds. And they're parking them in other places, and then they're parking money in bonds. It's going back and forth, and it's very volatile right now. And why is it so volatile? Because of the presidential administration, what we've got going right now. Before, there wasn't a knee-jerk reaction. When he got elected, everybody was saying inflationary. He's got all these things he's going to enact, and it really took a good year before we saw anything. It was the end of the year where we got the tax cut, the big tax changes. And that's where we saw the first thing, and that's when we started to see volatility in interest rates. Because prior to that, there really wasn't a whole heck of a lot that was going on. And before that, I said, well, there's not enough rubber meat in the road, so that's why we've had no issue with interest rates. Now we've got, this is what I used to use for a slide of the things that hadn't happened, and guess what? Tax cuts happened. Infrastructure, they're talking about it right now. Trade war, definitely talking about that. They're talking about going deeper, and then they peel back. It's like they're watching the stock market, see what's going on, and it's very volatile right now. So before I was saying not enough rubber meat in the road. Now there's plenty of rubber meat in the road. And so more inflationary. And so what's going on? We're getting gyration in the bond market, and we're getting it in the stock market. And I've seen this guy over and over again. USA Today. It's just a great picture of some guy on Wall Street that is goofy looking, that is pulling all of the rest of his hair out. And there is a cost to waiting that I like to point out. And as interest rates go to 4.5% to 5.5%, you have to understand what happens to your payment. Your monthly payment at, let's call it $750,000. That's close to the median sales price of $710,000. It goes up $458 a month every single month. That annual payment increase is $5,496. That's $27,480 over just a 5-year period of time. Remember, you're buying a 30-year loan. If you stay in that for 30 years, multiply that by 6. That's a lot of money that you're throwing out by not pulling the trigger now. And if you look at $1 million, this is hypothetical, of course, rates are a little bit higher, but when they go up 1%, what I'm trying to show you and illustrate is $611 more per month, every single month. That's $7,300. I don't care. If you're a $1 million family, a lot of families are out there that have $1 million property and they're dual income. They can use that extra $7,300 per year. It hurts. It hurts anybody. So we can't discount that. So understand that it's best to make the move now while we know where interest rates are and while everybody is talking about interest rates and the pressure of them going up from here. So is it a good time to buy? I get this question asked all the time, and my answer is don't look a gift horse in the mouth. And that's an old colloquial saying that means if you're given a horse, you don't look at its teeth and say, yeah, I'll pass. You're given a horse. It's a free horse. Take that horse. So the same thing with interest rates. I was telling that to people when it was 4%, and then they snoozed a little bit. When they snoozed a little bit, they snoozed and lost a couple $100 per month. That's extra money every single month. So you wait and look, this is a history lesson. I want you to know that 4.5% is a great rate. 4% was a great rate. Don't hold out for rates to get back down to 4%. There's so much pressure behind interest rates now, not going to happen. The 2007, prior to the recession, where we were at 6.35%. In 2000, we were at 8%. In 1990, 10%. And in 1981, we were at 16.6%. That was the average for the year. It even got higher than that for a couple months. That's a payment of $10,449 per month for a $750,000 home. Anybody want to pay that? Heck no. So this is my history lesson. I heard a millennial, and I'm not kicking millennials, but I want you to understand. I heard a millennial say, my husband is really nervous about interest rates getting to 5%. I'm not. I've seen much higher. My first interest rate was 8.5%. 4.5% is a total deal. 5% is a total deal. Where do I think that interest rates, due to the fact that we're a higher price market, where is it going to hurt us a little bit? Where things will slow down a bit, not hurt us, but actually we'll move more towards the balanced market, is at 5.5%. And I don't think that we're going to get to 5.5% anytime soon. And when we do, we're just going to be trucking along a really flat line, not appreciating much at that time. So my wise words are, pull the trigger now when they're at 4.5%. Don't wait till they're 5.5% when now you've lost all that extra appreciation and now you're flatlining it for several years. Take advantage of the appreciation that we're going to be realizing right now. So, this convoluted chart just shows you what the cost is of waiting. If I'm just going to do one, and I'm going to do $3,500 a month. It's a desired jumbo mortgage, let's say payment is $3,500 per month. When they were at 4.5%, you were able to afford a home of $863,500. That's where they are right now today. When they get up to 4.75%, you're now looking at $838,000 home that you're able to afford. When it gets to 5%, you're at $815,000. Do you see what's happening? You're going from an $863,500. When it gets to 5.5%, you're now looking at a $770,000 home. That's almost $100,000 difference. Don't snooze on this. Pull the trigger now. And then staying put. So I have to talk about this. The reason why we're having inventory issues is because we've had this trend where not enough homes have been coming on the market for a very, very long time, and that's not changing soon. And last year was no different. We only put on 38,756 homes. The last time we put on that few was 2012. But you can see we didn't do that from 2000 to 2008. As a matter of fact, in 2004, we put on almost 64,000 homes. That was an additional 2,000 homes per month, every single month that we were putting on. That's a lot of extra product for all the buyers that are griping and complaining about not enough product to purchase. And they had a right to gripe and complain because we haven't been putting on enough homes, and it's been a trend that is here to stay, and I don't see it changing anytime soon. So just understand that. All of Orange County is right now turning at a rate of once every 20 years. People are staying in their homes on average today based upon the number of people that sold and the number of houses that are available in all the housing stock in Orange County once every 20 years. It used to be once about every 10 years. Now it's once every 20 years. So let's talk a little bit about the market overview. I want everybody to understand the higher the price range, the longer it's going to take to sell your home. And if you're in the $6 million to $8 million price range, you're looking at a couple years to sell your home. But as you can see, it does hold true. The only place that this is a little different on the chart is $8 million plus. It drops down to a year from 2 years. That's still a very, very long time, and that changes all the time. And as a matter of fact, in December, it was 1,000 days for $8 million plus. And but I just show you most of the market you can see is below 750,000. It's 57% of demand, even with there being so few homes coming on the market, and it's 34% of all inventory. And the luxury home sales, I want you to know that last year we sold more in luxury. Remember, we're hearing it. There's all these news articles right now talking about luxury home market is cooling off. And I've heard it over and over and over again. USA Today, saw it in Forbes. I'm going nuts. I want to call up all these writers or email them and tell them they're wrong. At least in Orange County, they're wrong. And let me show you why. And it was something that was done from Zillow, so I should probably contact Zillow. So over 1.25 million, the most homes ever sold in 2017. And if you look at 2016 was a record, 2015 was a record, beating 2005 was the prior record. And if you look at, that was up 20% year over year. Now let's flash forward the first quarter of 2018. We sold 805 homes above 1.25 million. That's more than ever before. Again, more than ever before. And that's recent. So does the luxury market, has it stopped? No. What we're hearing, and what I've heard from a lot of agents, and what I'm seeing in the numbers, is as you saw, inventory is actually, rising above 1.25 million. We have more homes on the market. They're competing against more people, yet we're closing more. It just feels like they're bumping into a lot of neighbors that are placing their homes on the market at the same exact time. Does that make it a buyer's market? Technically, yes. Above $1.5 million is a buyer's market, technically. But everybody above $1.5 million, what they talk about is they don't really have to sell. And they don't. They don't move really fast on price, and they'll be on the market for 1,000 days before they reduce the price to where it needs to be. They're very stuck in their price. So you have to understand, even though it's technically a buyer's market, what that means is buyers have a lot to choose from. Does that necessarily mean that they're going to get the right price for a home that they want? Not necessarily. So, that one's wrong. But it's not up 20% year over year. I just updated this slide this morning, so bear with me. Going from 721 to 805, probably closer to about 10%, not much more. Luxury inventories right now, 39% of inventory and 14% of demand. But really, I want to tell you, the top 10% of the market is what I really term as luxury. That 1.25 had been luxury for quite some time. They actually, luxury homes here in Orange County, the top 10% is at $1,395,000 plus. So if you got a $1,300,000 home, you're in a pretty home, but not technically luxury according to my calculations. Orange County median housing price, I bring this up because June 2007, we were at $645,000. That was a record. March 2011, we bottomed out at $410,000. And since then, February 2018, the last median sales price, $710,000, up 73% since March of 2011. So everybody needs to get to know this guy. This guy replaced Janet Yellen. This is Jerome Powell. Get to know him. We're going to hear a lot about him. You don't know his name yet, but you will. And understand why, because they are going to be pulling the trigger on short-term rates over and over again. They want to do it 3 more times this year. They tend to do one in December, so 2 from now until the end of the year. And also understand that the Fed's in uncharted waters. They haven't been here before because they borrowed a lot of money in something we call quantitative tightening and quantitative easing. They were borrowing against the. They were actually fueling the secondary market. I'll explain that in a second. But now they're doing the reverse. They're doing quantitative tightening. What they did is around the world, everybody was buying paper. And they were acting as the secondary market in order for people to buy houses. It used to be that investors would buy the loans off of the banks that you go to out there, all your name brand banks. They would buy the paper. Investors stopped buying because they didn't like that as an investment. That's why everything collapsed. So who came in? The Federal Reserve. They propped up the market for several years, and now they want to reverse that course because now we're on a stronger footing. And what they're doing is they're peeling back their balance sheet. Their balance sheet was at before the Great Recession. You can see in 08-09 they were at $500 billion. So that's what, $500 billion. They have a balance sheet now of over $4 trillion. That's what they did by buying paper. Now they're starting to unwind that at the rate of they started in October, November, December. They did it at $10 billion per month. Then January, February, March. January, February, March, it was $10 billion per month. Now, we're in April, May, June, it's $30 billion. Then it's going to go to $40 billion per month. Then it's going to go to $50 billion per month. This, too, is starting to do something with rates because they're peeling it back. The money that they're investing in the secondary market, investors now need to come up and make the difference. Now that investors are doing it rather than the government, we're seeing a little bit more volatility in interest rates, which is why interest rates are changing on a daily basis. So where do we go from here? I love this slide. Because everybody's looking at me like, I know everything. I can tell you this. There is something I do know. And as far as interest rates, I've had that wrong for quite some time, and now we're talking about interest rates going up, and it's finally happened. But it's like the sky is falling, eventually the sky is going to fall. So, but really, what I can tell you is we're having a supply issue. Not enough homes. We talked about that. And we have a demand issue where interest rates are still really good historically, so it's fueling this gigantic demand. So we have a lot of demand and very little supply, and that's not changing, and it's not changing rapidly enough. Yes, we did get a lot of inventory the last 2 weeks. Like I said, most likely a blip on the radar. So anyways, I'm Stephen Thomas from reportsonhousing.com, and this isn't for you guys, but this is for when I meet with other people. Sorry, I forgot to take these out. But I do tweet at House Reports. If you want to get my tweets, you can go to at House Reports, and I do tweet. And that's my part of the presentation. And now we're going to get into Q&A with Jordan. So we go on to part of the dose.
Yeah, thank you, Stephen. I forgot to add at the very beginning something I mentioned to add, which is that Stephen normally does these presentations for very, very large groups. So this is a very special opportunity that we have to hear directly from him. And have you done live on Facebook before?
Yeah.
You have? Okay,
yeah.
Well, good. Well, I don't feel as special, but I feel pretty special. So, definitely a unique opportunity. And
it's actually only my second time of doing the presentation in front of somebody. It was much better the first time I did it by myself.
Oh, very cool.
And that's why I asked if it was backwards, because it was backwards. Everything was backwards. But that's why you have to have somebody with you.
Yeah, and what's interesting is that I had a number of questions, but I think that Stephen was so thorough that there's not a whole lot of questions. One question that I think comes up a lot is, do you think there will, and this I guess is a longer term trend, but do you think, or do you foresee a millennial effect on housing, being that millennials like to be free, which means they like to live on mom and dad's couch and not own real estate and rent. Is that a myth, or do you see?
Yeah, that's actually a myth. It's been debunked over and over again. Everybody wants that dream of home ownership. Mm-hmm. And as the millennials, you have to understand, we're talking about the millennials, and they hadn't even come of age. Mm-hmm. And everybody's coming of age a little bit later than before. Shoot, I just had a kid. I'm 49, so yeah, we'll call that late. But there's a lot of people that are having kids in their latter 30s, 40. That's a different dynamic than what we were dealing with 20, 30, 40 years ago. So what that's doing is they're a little freer and all that stuff. But as soon as they start buckling down at that job, which is what we're seeing now, and they're having kids, they want to settle down. They're not going to be like plopping all over the place. Boy, that doesn't make for a happy lifestyle and a happy marriage either. So
that's more noise.
That's a lot more of that noise. Yes, absolutely. Millennials want to purchase. Their problem are the baby boomers won't move. That's the big issue. The baby boomers right now currently are aging in place. But that is eventually something that will slowly but surely give. But currently not right now, stubborn. The baby boomers aren't moving like everybody had anticipated many years ago when we were prognosticating when the baby boomers were going to be coming of age. They're staying in their homes.
Interesting. And you mentioned in your presentation that you anticipate as rates kind of hit that 5.5% that we may plateau. Now, what would be the determinants in seeing a plateau versus an actual adjustment where we give up 5%, 10%, 20% of the price growth that we've seen, which again is probably more noise, but what are your thoughts on that?
Yeah, we have to see a lot more inventory to hit the market for there to be a lot of pressure on pricing. And my issue is that when things slow down, there are a lot of people, if interest rates get up to a certain point, they're just going to stay put. They're going to stay put in their cushy 3.5%, 4% interest rates.
Interesting.
Where their payments they can afford, because the lending has been so strict that people are actually able to afford their payments, so they're going to be staying put. So they're not going to be coming on the market. Now you're only going to get the people that have to sell, the have-tos. And there's always these life events that happen where you want to be closer to where kids have moved, or you've got a great job relocation, or those things. Those are have-to events, and those always take place. So there will be some movement. It's just that the people that are one of the discretionary movers will pull out of that. So we're just not going to see as much inventory. We will see inventory trickle up, and when we start to see that, that's where you get more of a balance.
Interesting. Do we have any questions from the audience, Russell?
Maureen wanted to know, my home was worth
is worth about $675,000 and paid for. I'm considering selling and buying two smaller properties at about $400,000 each, one for me and one for investment. Would that be a good idea?
I'm
sorry. Where is a good place to buy where there's lower priced homes?
That's it. Yeah.
Anywhere but here.
Anywhere but here. Pretty much California. It's California coast. Everybody loves the California coast, but California coast is expensive. And now you got other areas like Seattle. Seattle's now become this tech hub. So you have to get out to the outskirts, and even the outskirts are starting to get more expensive in Seattle. But you have to understand Seattle's what? They're on the coast. It's not quite like here. You have to wear a really thick wetsuit in order to go on the water over there, and it's not quite the same thing. They have a little bit more fog and rain and all that. But yeah, when you're along the coast, that's where it's expensive. And the same thing happens on the other coast, the right coast. They have the same issues along the coast. So everywhere in between, there's plenty of great opportunities. My thing is, if you know somebody like I have family members that are in Wisconsin, that might be someplace that I might want to invest, because then I have somebody that, you know what, I might pay my brother to oversee that. And him take that burden, and he gets to make a little bit of extra pocket change, and I get to take advantage of his house that went on down the street at $275,000, 3,000 square foot in the basement. So isn't you could do a lot with that $400,000 that she's talking about. You don't even have to overdo it, and the rent, you're going to be cash flow positive probably right off the bat.
I think that's a great point. Yeah, I always think, it's like Warren Buffett says, invest in what you know. And so when you have, and the same idea, it's not what you know, it's who you know. So when you have feet on the ground in a certain market, I think that's a great opportunity to try and plug in, because there are many great places in the country to invest. But if you have some kind of connection to people, that's a great place to start. And I think the other thing to consider is lifestyle. Is there an opportunity to buy in a place that you may keep as an investment for the next 5, 10, 15 years, but could actually end up being a place that you spend some time later on in retirement?
Sure. Then look at Arizona. There's plenty of opportunities in Arizona. There's plenty of opportunities in Nevada. And that might be a place that long term that you look at for yourself. So that would be also an extremely wise move, and you can get there in a day.
Right.
So I have a question for you. So my wife Heather is watching right now. We've been going back and forth, living with her parents, saving for a house. We're right at that 3% mark, and we're on the fence of, do we pull the trigger? Interest rates went up, kind of intimidated us a little bit. But do we pull? What are the pros and cons of us, going in with 3 or waiting to come in maybe with 10?
Yeah. If you're going to wait to go from 3 to 10, you're going to be waiting a little bit. Probably too long in my book. It's the same thing I told my sister when she purchased her house in Wisconsin. It was at the time when interest rates went from 3.5% to like 3.75%. And I told her, she goes, "What should I do, Steve?" I said, right now, purchase. You know what it is today. You don't know what it's going to be tomorrow. You just have to be married to the payment. Because at the end of the day, 6 months from now or a year from now, what are you going to be paying on a monthly basis? The payment. Who cares about what you paid for it? You have to own that payment, know that you can afford that payment on a monthly basis, and when you can afford that payment on a monthly basis, long term, real estate's great. I could show you lots of charts that show you. Real estate long term is phenomenal. It's another investment to go along with your portfolio of stocks and bonds and everything else. I say all in, be in real estate, have investments in real estate. It could be even your starter townhome that you're talking about, or starter condo. That could be your first one. And then you get to the point where down the road you're making more money where you might want to rent that out, keep it, pay it off, go get another one. That's also a very, very smart idea. There's plenty of people that are doing that out there right now, which is causing more of our problem of not enough inventory.
Yeah, and I just a couple of things to add to that too. I would say one of my favorite sayings my financial planner always says is, when is the best time to plant an oak tree?
Yeah.
Right? 5 years ago, 10 years ago. So start now versus thinking of what could have been or what will be in the future. Another thing I would say is stop looking. A lot of people look at their primary residence as an investment, which it is part investment, but I think people forget to consider this is a lifestyle choice, right? This is you are not being dictated by your landlord as far as where you're going to go, what color you can paint your walls, et cetera, et cetera. So you're making a choice where you're doing this for your family. And yes, look at the investment component as a secondary piece. And the third thing I would say is, like Steven said, real estate in the long term, you're always going to have peaks and valleys, but we know that the next peak will always be greater than the previous peak. Has that always been the case?
That where we at right now?
Yeah, and and will the valleys hurt? Absolutely, but only if it's in a position where you have to sell. Because if you don't have to sell, it's just a paper loss, right? On paper, you've lost money, but you haven't really lost money. So if you're looking at real estate for a 2 or a 3 year time horizon, it's too short. But if you're looking at it for a minimum of a 5 to 7 year, I'm going to buy and I'm going to stay here for a while, you're pretty hard to go wrong.
Yeah, I was just talking to a gentleman that owned his home for 30 years, and over that 30-year cycle, seen a lot of cycles. Seen his money go way up, come down a little bit, come up, but from the very beginning to where it finished at, handsome profit.
Right.
All right. No more questions here.
All right. Thank you,
Wonderful.
Stephen, for joining us.
You
Appreciate
betcha.
your time.
My pleasure. A lot of fun.